Good. Okay. Everybody hear me? Yeah. Good. So thank you. Welcome. I'm Oswald Clint on the Bernstein Energy team here in London, and together with Neil McMahon, we keep an eye on the global oil and gas markets, but particularly today, looking at the European and global unconventional gas space. And I'm going to focus on it from a more global view, dipping sometimes into particular areas such as Europe, especially Poland. I just came back from Poland, so I've had a recent field trip there and also caught food poisoning at the same time, so I know the country quite well. But I think what you'll find resonating through this is a lot of what David said in his humble opinion of costs, environment, and rocks. Because there's clearly for us too some of the three most important things to be focusing on as we try and understand, can this make an impact in Europe and other parts of the world as well, as successfully as it has in North America. So, the question is, how does it fit into the global gas markets? And I think this chart tries to explain why we need to be pursuing these gas resources. This is showing you, the green is obviously oil demand from 1965 through 2009. The red is natural gas demand over the same period of time, and just look at the slope on that chart. It's pretty impressive. 3.5% annual growth over such a long period of time, much higher than the equivalent oil demand pace through that period of time. Now the bar chart is showing you the global onshore, shallow water, deep water oil and gas discoveries through that same period of time. And the dotted line is the oil price. So clearly you can see that discoveries have, these are conventional discoveries, have fallen off somewhat substantially over that period of time, and especially over the last 10 years. And even in the last 5 years, if I was to zoom into the black shaded area of some of these, you would notice probably 30, 40, 50% of these bars are actually mostly Brazil, mostly Santos Basin discoveries in Brazil. So the gas demand, we think, is going to continue at least at this pace, and therefore we need to do something about this. So that's the impetus, I guess, for seeking out any resource that is feasible. I think why is it also important, and this is just a collection of some other areas of the world where we see gas demand growing, and I think you can break it down. It's not just about North America. Yes, 4 years ago we would have had North America up here as well, showing a tightening supply-demand balance, and therefore a need for a new supply. Today we can put the US to the side. They have a resource base which is working. But in other places, such as South America, we also have an increasing import dependency trending through our numbers over the next couple of years in South America. The Middle East as well is another area where we see increasing gas demand coming through. Qatar does have a lot, but we're seeing increasing problems in many of these other countries, especially Iran, especially Iraq. Saudi Arabia in particular is one area where we think they could start importing LNG in the near to medium term. Down in China, we also believe the growth story in Chinese natural gas demand. We're not quite as high as some of these very strong forecasts here, but we're certainly much higher than some of the US forecasts. So the vertical grey bars are our current forecast for continued Chinese natural gas demand. In Europe, we've had a big deficit for a number of years. We're currently in a period here of oversupply because of the weak recession. Natural gas fell 5% last year across all of Europe. It's never fallen more than 2% in any of the previous 4 economic recessions to hit Europe, so it was pretty substantial. There's a lot of LNG has started to come into Europe, and that's giving us a little bit of a surplus here. But we do see that as a short-term phenomenon, because if you really understand the domestic supply base, you really understand Russia's ability to bring on greenfield projects in Yamal Peninsula, et cetera, it doesn't look too promising as we go out over the next decade, even in Europe. So this is all setting the scene. So shale gas has come through in North America in a big way, and it's, in the financial world, it's really starting to impact the things we look at. So this is commodity prices, natural gas. The blue line is an oil-linked gas price that Gazprom charges European customers. And then back over the last, from 2005 through to the early part of 2008, it wasn't a problem relative to spot natural gas prices. And in here I have the US price, the UK spot price, and also European spot price which does exist as well. And you can see that customers didn't really have too much to argue about during this period of time. But through the back end of 2008, as increasingly this North American shale gas was increasing, you can see that it's pressured the US gas price, obviously, but it's also starting to impact UK. We feel it's impacting UK prices and even into European gas prices. So it's this gap which is a problem today, and that's the force that the customers can use to push back on some of the importers from Russia, from Algeria, and from Norway. So that's one obvious effect of shale gas on commodity markets. Even in the stock markets, it's having an impact, and here I'm showing you the impact on a key natural gas exposed company selling into Europe. So not even in the US, but this is Europe. This is Gazprom that derives most of its profits from gas sales into Europe, and you can see its weak relative performance to the stock market over this period of time, compared to Tullow, an oil producer, and I put that in just to keep David happy, a little Tullow chart. But this is like an oil producer away in Africa, away from all of what's happening in the gas space. So clearly, to us, it's also having an impact on gas-exposed companies, which is a problem, especially because I like this stock. But so what is the thing? What is it all about? Well, then we have to understand the resource base, how big it is, and really what we're talking about here. There are multiple estimates for the total resource base. All in, today the figure is around 33,000 trillion cubic feet of gas, and that's split by region on the chart here on the left-hand side. True, this number may change over time, but clearly you can see that the biggest estimates today are expected to arise in North America, dropping down into Russia, and then really China after that. And then, but clearly what's important here is certainly, very visually, is Western Europe, Western and Central and Eastern Europe here falling off compared to this resource base. And it's split, and yet, as you can see, the black area is the shale, and if we just scale that up here in percentage terms, you can see how dominant shale is as a percentage of that resource base in all of those nations, absent of the FSU, which is very much a coal base in the Kuzbaz region of Russia. They're trying to target some coal bed methane here at the moment, but the focus will be increasingly on shale across most of these regions. So, and that's why we're seeing the success in North America spread out, the tentacles are spreading out, and the technology that's allowed this resource base to work is starting to spread globally. And whether it's down into Argentina, into the southern parts of South Africa, especially in Europe now, multiple countries proclaiming to have workable shales, into Russia, as I mentioned. Chinese has obviously a lot of coal as well. It's a big part of the resource base. But they do have some shale. It's not really being targeted just yet. The coal bed methane, CBM, is a dominant resource base. India as well has similar resources. Indonesian coal bed methane, the Australian coal bed methane we know about. Australia also has some shale, and then some New Zealand shale. So this is really where the industry is taking positions today, and the key focus areas for the industry, for financial people, for investors. And as a consequence of that move, very roughly, we can take a look at what that's going to do to the big Western energy companies as they change their portfolios through time. And what we see here is that just over the next decade, we will see a marked jump in the percentage of unconventional gas as a percentage of their total production coming through this period of time. So we're jumping up from about 10% unconventional gas to more like 14, 15% over the next 10 years. And that's really predominantly US, though. Most of the positions the big companies have taken in North America over this time. But we can expect this to increase. So, but I think before we get carried away, it's important just to set the context here, how quickly these resources can come on scale. And here's the two clear examples of the two producing basins today. One on the left is North America, and the black area is combined coal bed methane, shale gas, tight sandstone. Those three resources, today roughly 46% of total US gas production. So a very significant proportion, and obviously increasing more markedly over the last 10 years. So I mean, here, this is a 20-year view, and you can see how it has scaled up over time. In Australia, it's taking longer. It really only started in 1999, and the CBM has grown about 500 million cubic feet per day coming out of Australia and Queensland from coal seam gas, coal bed methane. So this is our two examples that we can always use to understand the pace of development. And remember, these are environments, and we'll see some images later, environments where access was relatively easy, and that's pretty key when we try and translate this success to other parts of the world. So this is what we're talking about in terms of Europe. This is a good chart. It actually comes from Schlumberger, and it just shows you that the shales in northern Europe that we're targeting here, coming down into Poland, across Poland here. Then we have there's a lot of shale running through Switzerland as well, but then there's a lot of tight sandstone, and then patches of red coal bed methane across Central Europe, and of course there should be some up in Cheshire and Edinburgh as well. But these are the big resources that will be targeted in Europe. Obviously this is stretching into the Ukraine as well. So I think it's useful to look at how these test beds have performed so far. And this one is a Hungarian tight sandstone, which is our first example we can go into because it's gone through the experimental phase already. So as we know, Falcon Oil and Gas, ExxonMobil, and MOL, the national part-listed national oil company in Hungary, have already pursued an experimental program. It was $50 million total cost, and they drilled a couple of wells, but one here with 3 fractures, hydrofractures down that vertical bore, and this is the results coming out of each of those stages. And I think ultimately what we're seeing here is that the flow rates were wholly disappointing. When we're down to thousands of cubic feet per day, we're definitely not at the range we need to get overly excited about these. This is a tight sandstone, by the way. We need millions of cubic feet per day to start getting overly excited about these shale resources. Also, one of the problems with that tight sandstone in Europe, in Hungary, here is what looks like a lot of hydrogen sulfide and a lot of carbon dioxide coming through these streams, added to the high incidences of water coming through at the same time. So ultimately, at the end, early this year, 2 of those companies decided to exit this plan. So it's not at the moment a big focus point for European unconventional resource development. So, well, that takes us to the rest of Europe, and especially into Poland, which is the next sort of hot spot. It kicks off this year. There'll be 2 wells drilled in the second quarter, potentially a third in the third quarter. But firstly, let's get back to the rocks, because in the north part here we have a cross-section from southwest to northeast Poland. And what you see is, and you may know that there is a large suture zone deformation band running through northwest to southeast Poland, and that's what we're capturing here. You can clearly see this extended zone of deformation, which is obviously causing a lot of rock damage in that period. So what we do find is that the companies that were first into Poland, taking the acreage very early, are intending to be drilling up here, where this brown Silurian shale is much shallower, and obviously makes a lot of sense. Depth is a critical factor here in terms of drilling costs. But you can imagine, the closer you come to the zone, the deeper the shale is becoming, and also the quality of that rock will have question marks surrounding it. So it's definitely the first case here. There's a lot of question marks still around the quality of the rocks in Poland, absent of this area up here. Now, in contrast, there's just a cross-section across the Barnett Shale, showing you these very gently sloping sedimentary beds here, which have been targeted for some period now, and very successfully, as one of the oldest, longest producing shale plays in North America. And you can see here the depth of the Barnett, remember, is 2 to 2.5 kilometers deep. Obviously, this shale up in Poland will be much shallower than that, which is positive. But once we get down to these areas, we will be dropping to some significant depths, down to potentially 6 kilometers. So the second problem, or the second concern that we would have in terms of getting overly excited about this resource base in Europe, is population density, and these are two maps that very clearly show you, plotted the shale gas basins in North America in the black here, together with population density, and then we just take a quick look at Europe on exactly the same scale. So the color coding could be a bit better here, but you can see that we're talking about a different population density. This will have an impact on development pace, and that's what we're trying to understand here. How quickly can this take off or replicate success that we've witnessed in North America? Thirdly is rig capacity, and obviously this can be fixed, but we're starting off a low base at the moment. Certainly in Poland has only 7 rigs, land rigs running at the moment. There's only actually 74 across all of Europe. Clearly there's not a big need for them, but we would need to be stepping this up materially. Just in context, there's 1,500 land rigs operating across North America. So what's interesting here is, you know, when you go to Poland and you talk to drillers and understand, it's not quite as simple as just importing American-built rigs into Poland. There are issues with the metric system and the imperial system on measurement units, which do cause regulation problems bringing them in. So it's not a quick fix. And also, European import requirements seem to be delaying the import of new rigs. There's quite an extended regulation process for imported goods from whichever nation. That does seem to be a bit of a bottleneck for some of the companies importing rigs from outside the EU. Transfers within the EU are okay, and that does work, but that does limit us to 74 rigs. So we get back to land access and how easy it will be to go in here and just roll out multi wells per year, increasing the frac spreads, etc., etc. And I just want to show you some satellite images which I think are better than any words here, which highlight on a scale here, which is actually, you see the scale at the bottom left, a kilometer across this distance, and this is in the the Barnett Shale initially. And just you can see the individual well pads here. So any one kilometer, you're probably seeing 2 or 3 well pads on a square kilometer. So, and you can see the prevalence of them right across this area. And if you zoom out further, you will see that extending. In fact, this is the San Juan, which has got some shale but also coal bed methane in New Mexico. And there's 2 scales on this one. And this is half a kilometer dimension and 10 kilometers. So you can see we still have 1 or 2 well pads per 500 meters. And if we just zoom out on the left here to 10 kilometer scale, just look at that. And those are individual well pads all over this entire open, accessible shale resource. Now, there's a new resource, the Marcellus in Pennsylvania and New York State, and it's opening up at the moment. But again, here the problem will be forests and actually gaining access through the forests. And I guess it's kind of like Russia, certainly parts of West Siberia. But you can see, you know, you will have to cut down a lot of the trees in order to gain access to actually put down your well pads initially. So there will, again, you know, access is a very important factor for development pace. Now, if we actually then zoom into Poland, what we see is a very different landscape, and it's you know, consequence of the economy and what Poland is actually well known for, which is agriculture and farming. This is the same scale, half a kilometer here and 10 kilometers zoomed out in the background, but you can clearly see the numerous quantities of farmland across the same area as we just witnessed in North America. And the interesting thing is here that each of these is an individual farm held by an individual family. These are not large-scale commercial farms. So operators do have to go in and actually negotiate on a farm-by-farm basis. And that's also delaying the experience of getting planning permission, putting down your initial pad, and just the pace of drilling once again. One other thing about the EU, and it's also applicable to Poland, is protected areas. And Poland joined the Natura 2000 policy back in 2000, which means a lot of the land is actually protected, and it's highlighted here in the yellow, which, you know, like parts of North America, are just off limits for 2000, which means a lot of the land is actually protected, and it's highlighted here in the yellow, which, you know, like parts of North America, are just off limits for any drilling. So that again is something that will have an impact. And just to quantify some of those numbers or take them a little bit further, you can see that Poland does have over 1 million individual farms, but the average size is only 12 hectares. And if we compare that to the US, where you can see an order of magnitude increase in the square acreage that most farmers actually have access to. So you can see how easy it is to negotiate with a farmer here and gain access relative to Poland. And that's because Poland is a good majority of the population is involved in agricultural, and in terms of the economy, it's roughly 70% of their economy. That's relative to only 6% across the rest of Europe and 1.5% in North America. So farming will play into the success of Polish shale gas. The other issue there is as David was latching onto as well, is water. And this is water dependency map, actually coming from the United Nations, and you can clearly see North America, not very dependent on imports or any type of water needs. Switch across to other areas of the planet, South America, Africa, Middle East and Europe, and you can see that the dependency is just rising through most of those regions. And you can see the scale here, anywhere in red, is actually 60 to 80% of their water dependency has to come from surrounding countries. So there are a lot of water transfers going on globally that we have to be aware of. And then in terms of actual water per person, per acreage usage per year, you can see somewhere like North America plotted here, scaling up very favorably versus some of the European countries which have shales and also seeking to potentially develop them. So there is, again, big differences here in water availability on a population basis, on a farming basis, etc. So, there's many ways then to compare and contrast these different shales, and this is one that's being constantly added to over time, and it simply is taking a number of the big 6 or 7 big US shale plays at the moment and coming down through all the typical metrics, thicknesses, the depth to the shale maturity, silica content, porosity, etc. And this is Poland in the right-hand column. It's still being populated, and I would say, despite what you see a range of numbers here, this is really coming from very limited cores or very limited wells. There's only actually been about 5 wells drilled in northwest Poland, and the cores were there. They're in the Polish library for the last 40 years. They cost 5 cents for a 100-meter length of core. They're very cheap to pick up. Land was cheap in Poland. Today it's about 55 cents an acre. Compare that to the US, where it's $14,000 per acre. It's a very readily accessible area to pick up a position, which explains why we've had this land grab. But I would say, these are the data that we have today. There's a lot of question marks. The depth is clearly towards the lower, the deeper end here, more like a Haynesville, we would say. The rest of it, I think, at this point, it's just too early to say. Are these firm numbers that we can run with? But at the end of the day, it really boils down to numbers and economics. And that's one of the most enlightening things today that we can work off, and it is how economic does an individual well become given all the costs, gas prices available in that country. And this chart is just taking that oil-linked price that we showed you at the very beginning, that blue line, which was a Gazprom price, which is around $9 per 1,000 cubic feet. That's more than double the US price today of $4. Now, some of the wells being drilled this year, which are vertical wells, which will do some fracturing tests, are costing around $10 million all-in cost. There is a favorable tax environment in Poland. The royalties are not too harsh, less than 1%. And some standard inflation here. We arrive at a 13% return here for a particular well being drilled in northwest Poland, where that shale is shallow. But one of the interesting things which we still have to understand, the Polish shale has a lot of nitrogen in it. It's not like Hungary, where there's a lot of CO2 and hydrogen sulfide, but it does have a lot of nitrogen, which is not toxic, but it does actually realize a lower price in Poland as a result. So you can end up with a good 30% price discount if you have 20-30% nitrogen within your gas stream. What that means is if your price was to drop by that level to high sixes, $7, then the economics become much more challenged, assuming you can't drop your costs substantially. So again, I think it is another risk about the quality of the gas stream that comes out of these gas wells through this year. And I think, the question, obviously maybe somebody will have the point that costs do come down in these basins over time, and that will help the economics. I think that's not really our experience looking at some of these basins over time. What we do find, and this is the Barnett, so the oldest producing basin, shale gas basin, and this is one operator's data showing you that the costs the costs were rising, and the reasons for that were that those average stages per well, just as David was showing with the EOG data, the number of fracking stages has been increasing all the way through time as they try and sustain those initial production rates, which hasn't wholly been quite successful. We are seeing a gentle decline in the initial production rate coming out of individual wells from this play. But this is what's driving actual higher costs. And the statistic there at the top kind of says it all. The Barnett economics almost peaked in 2005, and that's when production was only 10% of the peak output levels of that play. So I think there's not enough data yet to say costs do come down successfully in shale plays, and that is a game changer, or will make these economic over time. So what can Poland do? What can Europe do? Well, I think one way to look at it, there's a number of estimates out there, but if we were to just assume that we can move into Poland and take all those European rigs, transfer them across, which we can do easily without going through the EU import requirements, put them all in Poland and start drilling today, and drilling 10 or 11 wells per year, and we're getting roughly, US-style reserves per well, US-style initial production ratios coming out from the first well, then in theory you could probably keep ramping up production in this region to this level, which is around 2 billion cubic feet per day, well, really by 2020, and going out to 2.5 billion cubic feet by 2030. At 2020, this therefore would equate to roughly 4 or 5% of European consumption today. So it's at the moment, in theory, that's what we could get to, ignoring all those land access problems, water problems, et cetera, et cetera. So again, but it's not significant relative to that deficit that I showed coming through in Europe as we go over the next 10 years. So I just want to, I'm not sure if I'm doing well on time.
You're doing fine on time.
Yeah, so I just want to finish then. I mean, as Europe is the focus area today. We step out then into the rest of the world. Most of those are still very experimental stages at the moment. What we do know is that China has significant resource, and they obviously will want to pursue those as aggressively as they're pursuing other commodities. And they do have a lot of coal bed methane here. A good 35% of their total gas resource base is CBM. And then they have some shale, which, as I said earlier, not really been targeted just yet. But the CBM has been targeted for at least the last 10 years, and as far as we see it, there hasn't been any great leaps in terms of developing this or adding it into the supply mix. And there's many reasons for that. I mean, certainly from the rock point of view here, we have the Chinese CBM compared to, say, the Australian Bowen Basin CBM here, which some companies are pursuing today. But one of the big factors is the permeability of the Chinese CBM is much, much lower, less 1 to 5 millidarcies relative to the 100 millidarcies that we witness in the Bowen Basin of Queensland, which is obviously leading to much lower flow rates per well. They're also less saturated, so the dewatering phase is taking a lot longer in China. Then you have the regulatory issues that you witness in China and the independents gaining access to the pipelines, kind of like Russia with their gas development. So a very similar story there, political bottlenecks, but also potentially a bottleneck on the rock quality as well for China. So I think that's hopefully giving you a glimpse into how we see the shale universe, the unconventional universe. I'd say we're probably on the cautious side here at the moment, and believe that we need to keep trying to develop these resources, keep bringing as much LNG, certainly to Europe, to meet some of these supply shortfalls. But obviously Russia will continue to be a dominant source of European gas from our perspective. So thank you, and I'll take any of your questions.
Any questions? And if not, let me ask one, which is in a way of just a clearing up. But you talked about U.S. unconventional gas production being 40-some% of the total nowadays.
Yeah.
But that is mainly from is unconventional in the sense that it's tight sandstone.
That's right.
So the actual production from shale gas today is
about 5 billion cubic feet per day.
Okay. And that's where it's commercial, clearly.
Well, we would
well, maybe clearly not.
But that's where it's at, and it's ramped up quite quickly. That's only 3 or 4 years. It's come up to that level. But we would say a lot of it's being produced at sub-economical prices.
Okay. And we'll come back to that a little.
Yeah.
We'll come back to that a little in the first. Phil.
Keith.
Keith, you've got the microphone. The man who has the microphone gets to speak first.
Yeah, a couple of questions. I guess first one about gas prices, because presumably the U.S. shale gas players, recognise they're losing money at the moment, but they're making a bet on future gas prices. And so, what's your, how do you see that panning out, U.S. gas prices? Second thing is just the Exxon XTO, the $41 billion that Exxon paid for. Do you see that as a good deal or a bad deal?
Well, we are positive on commodities. I think our belief is that these lines reconnect up to these lines over time, rather than this line collapsing down to this level of stock price. So therefore, we do think that we will see a decline in the unconventional gas over time, or at least certainly at these prices. Maybe we never see $10, $11, $12, $13 per MCF gas prices. It's like there will be a switch when a lot of this unconventional resource can be switched back on again. But for us, we need high $6 to $7 per MCF to really generate a healthy 10% return on capital to go ahead and drill your next well. It's confusing for us to see as much activity at today's gas price. So we do expect some supply declines to come through, and that actually will help increase the U.S. gas price here. So our forecasts do go higher, but they don't obviously go as high under fundamentals as we used to believe, 3-4 years ago. So we would have probably a single-digit upper cap, perhaps on U.S. gas prices, rather than the double-digit price levels that we had before. Exxon XTO, yes, we would also believe that we need a pretty high gas price to make that economically feasible. At least it will take a number of years for that to be, on a financial basis, to be accretive for that deal. It does imply quite a high gas price as well. But that doesn't get, if you look at Exxon's 2030 view on the world, they also have very high natural gas demand growth estimates. They always have. They always have that 2.5 up to 3% CAGR demand growth. So you can clearly see that they believe in natural gas demand. Kind of like the last 40-year chart that we looked at, again, clearly they also believe that this is sustainable going forward, and therefore more gas in the portfolio that can help meet that, the better. So we don't feel it's like a late move just to catch up on shale resources.
Okay.
In terms of the complex multi-fracs, do we have evidence of how long those fractures will last for before the small cracks in the rock start clogging up?
Well, yeah, it's getting the real data is definitely tough, because typically what we get presented to us in the financial world is a collection of very high performance wells, and we're not getting the complete subset with the failures the wells do clog up and what that means for average flow rates, average initial production rates. So I don't have a firm database to give you an answer in terms of time, but clearly there are wells failing. There are wells that are much higher pressure than is sustainable to produce. There are problematic areas of many of these shale plays, even in North America. Certainly, the further you move away from the core of the sweet spot of any shale, you are seeing those problems. In fact, a lot of the companies who are in Poland today are companies who ended up playing around the fringes or the margins of the US shale plays, not getting production levels sustainable or the economics to work, and therefore decided, let's be the first to seek out other resources.
Phil?
Yeah, my initial question was going to be somewhat similar to Keith's, which is this, I suppose, the elephant in the room, if we can express it that way, as to the dash for shale gas that we've all seen, set against some of the very sensible statements that you've made in your presentation. So let me just pick up on the second question about fracking. You illustrated very neatly with the point related to rig capacity what could be providing a cap on ultimate production within the medium term in Europe. Did you roll into that equation the ability of the service companies to provide, say, the fracking requirements for those numbers of wells each year? Because our view is that will limit things even further.
Yeah, I mean, the rigs in Poland are heavy-duty rigs. They don't have that capacity. They will need to be upgraded. Especially if you go, the deeper you go, they will need to be upgraded. The fracking, some of the Polish drilling companies, there are 3 of them, do have some capacity, but you're right, for large-scale development, no. Chinese offerings are certainly there, are trying to make a step inwards, but you still have that import bottleneck that I was talking about. So at the moment, I didn't factor it in, but yeah, you're absolutely right.
One more question?
I need to ask 2 questions from slide 24, 25, and 26.
Do you remember the numbers? There we go. That one.
From your Poland model assumption, you did say that you made an assumption that the initial gas production is 3.0 million standard cubic feet, and that the economic ultimate recovery is 2.1. What informed that assumption?
Purely an average of most of the US shale basins today, not the Barnett, which is obviously lower, at less than 2 million cubic feet per day. But it's a rough average of what we see from the 7 shale plays.
But based on the uniqueness of the shale rock, you will agree that shale rock has a diverse properties which change just from location to location. Therefore, I don't think it will be an accurate assumption, making an average.
No, but you have 5 wells.
Yeah.
Unfortunately, there's only 5 wells drilled in Poland that you have data from. You have to have a starting point, and that's the best analog that we can choose today. Poland has no data to input into a model. So you're right, it could be better, but it could be worse.
Okay. One more over here, I think. There we go.
Actually, my question to you, David, more than...
Oh, okay.
We've had a couple of freak earthquakes in Texas. Can you talk about the potential environmental issue there around shale?
Oh, no. Not something I know anything about. I mean, as I said, it just seems to me the environmental issue I would highlight is that you are having to dispose of slightly contaminated water or somewhat contaminated water and keep it clear of the aquifer. I don't know whether have you got anything to add to that? Certainly nothing on earthquakes or anything like that. Sorry. Anybody else? Was there? Yeah.
Hello. Just to come back on your NPV calculations on Poland. Based on different IP rates and different, I understand that the price needed to make this on Poland. Based on different IP rates and different, I understand that the price needed to make this economic would range between $7 to $9. I'm not aware of all your gas price forecasts for Europe, but I have a question on when you would see that happening and whether there would be a more suited contractual structure to sell that gas to be able to achieve that kind of price level. I'm thinking of oil-linked price versus spot prices.
Yeah, which is the crux of the problem, that if the shale comes on, if it did work in Europe and it did come on, it would put pressure on oil-linked prices, and that would knock off. I could cut the price in half, which would make it non-economic. You really need the oil linkage in Europe to make these work, given potentially the drilling costs, the capex requirements. So you need to sustain that oil linkage. To us, it feels, yes, we've had some changes, and I think you know well with Statoil's negotiations and Gazprom as well. You've had to accept some spot price element into your long-term contracts, but on the whole, customers in Europe are still willing to accept long-term oil-linked gas prices. So that is a positive, yeah.
Can I squeeze a last question?
Sure, cool.
I know every shale is different in the US, and it's the case in Europe, and also there are very limited data on the quality of the rocks in Europe. But are there some general characteristics that you could say characterize European shales, for example? They have more clay content, or they are more complex? Because these are things we read, but I'm not sure that's true.
Yeah, and that's why I want, in my column on Poland, I wanted to say, highlight these are question mark areas. We know it's older, so Silurian rather than the Devonian of North America and Carboniferous. So there's definitely an age element here in Europe and what implications that has. But in terms of thermal maturity, organic content, you saw the range on organic content from 0.4 to 9.9%. It's just a vast range. It's, I don't have the data. Companies who have got current wells are obviously still working and analysing it, and that can take, Shell are talking about 12 months for the Swedish alum shale, just to actually do the core analysis. So we're still very, very early in terms of giving proper data.
But you did say that in one of your reports that the depth of European shales was on average twice as deep.
Well, if you take 1.5 for North America, and then you think about 3 for Europe.
Okay. Not trying to draw it to a false halt, but exactly those sorts of questions we will get into a bit more detail after coffee with Phil Clark's presentation and Stuart Whiteley's, and then the one from Paul. So let's break for coffee and tea now. We will be back at 11. You will not